Said the last class, ideally you're as prepared as possible, but even if you're not prepared because work is grueling or your family is grueling or with a combination platter, always better to come than not to come, even unprepared. Prepared is always better. By this class, or certainly by next class, hopefully everyone's been able to order the book. Ideally the 18th edition, but at your own risk, the 17th edition. It's up to you, but again, not an electronic copy. Bring the real McCoy. Also, if you could regularly bring the code and regulations, like I said, by the end of the semester, if nothing else, hopefully you'll be stronger. Hopefully not only physically, but mentally as a result. So we'll see where that takes you. Yes, keep listening. If you can regularly bring your name placards, that's useful for not only me, but for your peers and colleagues to your left and right. So if you could, that'd be great. And if you forget, I usually come armed with more, so don't be bashful to ask me. The start of every class, my practice is to summarize what we covered the prior class, so that people, hopefully, if you're a little lost the last class, it gives you an opportunity to ask me questions. It also gives me a way to sort of transition into the new material. Some of you have had questions. Don't be bashful. Feel free to shoot me an email. Again, in terms of emails, just make sure you put on the subject line, student from your Monday night class. Do not just put your name in the subject line and assume that I don't think you're from some distant place looking for money because you're shipwrecked or somewhere like that. So just again, student in Monday night class is very useful for me to make sure I get back to you. And as I said last class, for those who didn't make it to the last class, I usually try that day to get right back to people. If you don't hear back from me, just don't be bashful, put an exclamation point, send me another email, and I'll be happy to get right back to you. Let's talk about chapter 1 and 2. We tried to cover last class. So again, my methodology is generally to start every class with a summary of the material that we covered prior classes. So this is no exception. So insofar as the first class is concerned, I said to you that it's an open book exam, so that means you're not going to be tested on any history, but I did want to remind you that our class, that you should bear in mind that there's a 1939 code, and the 1939 code numerically will be different, right, from other code sections that you used to. So if you see a cross-reference, for example, in code section 22, that is our current code section 61, right? Also bear in mind that there is a 1954 code. And that 1954 code, just seeing if you guys brought your name files. The 1954 code, good news is numerically, it dovetails with our current code, right? So you don't have to think about numerical changes, but also bear in mind, we have our 1939 code, we have a 1954 code, we have a 1986 code. Notwithstanding that we are still working off the 1986 code. Changes have been made, right? We are not stagnating in 1986. Changes have been made, but again, the biggest reform to date happened in those years, 39, 1954, 1986. When a new code comes into being, who knows? All right? We also talked about sources of authority, right? That sources of authority come in several different flavors. And that we will ask throughout the semester, what is your authority, right? That's going to be very common. For your clients, supervisors, and me, they will constantly ask, what is your source of authority? Jack, one source of authority is? Administrative authority, and chief among them, right? Lewis is what?
Treasury regulations.
Treasury regulations, right? And that, those, just to remind people, in the back of your Internal Revenue Code, if you talk about Code Section 61, simultaneously at the back of your regulations or at the back of your book, right, is Regulation 1.61 dash something, right? So Treasury regulations are renowned as administrative authority, but administrative authority also comes in the form of revenue rulings, revenue procedures, technical advice memoranda, at the low end of the totem pole. Brandon is what? Low end of administrative authority. Very low end. Alicia, you know?
Private letter rulings.
Private letter rulings, right, Brandon? Private letter rulings, which say at the very end, Brandon, right? This shall not be cited by anyone else. But what do? We cite to it. Just, you know, if there's nothing else, beggars can't be choosers, right? So we have an administrative authority and Anetta. Again, pronunciation is not my strength. Anetta, what other source of authority?
Legislative.
Legislative, known as the code, right? As the code. And Wes, anything else?
The treaty.
Treaties are one. That could be source. Wes, another. Say again, Wes?
Judicial authority?
Judicial. And so the pronunciation is...
Oh, you can call me Jay. A lot of people call me Jay.
I know that name. All right, Jay. Jay, tell us more about judicial authority.
Like the tax court.
Okay, so judicial authority has different tiers of authority, right? The lowest levels are?
I think the tax court is the lowest.
Tax court and district court, right? These are trial courts, they're fact finders. Win or lose at the trial court, where does it go, Jay?
District court. Federal district court.
Claudia, where does it go? Appeals court, right? And remember, this is not criminal, right? This is not criminal. We're looking at civil tax matters, right, guys? And civil tax matters means that whether the government wins or loses, or taxpayers win or lose at the lower level, it can be appealed, right? Can be appealed to the appeals court. Win or lose at the appeals court, Katie, can go where? You can. What do you need? What's your ticket to ride to the Supreme Court? Say again, Claudia?
You have to pay.
Well, you always have to pay like a filing fee, but I'm not worried about that. What's the generic term?
What
certiorari?
Writ of certiorari. It's Fasto? Okay. I got to work on this. Don't be bashful and correct me. Okay, I'm not just, I don't mind at all. All right. The writ of certiorari, and we know, Katie, that Supreme Court doesn't want to hear too many tax matters in the year 2016, right? And many of these issues, at least in the mind, the big issues, Supreme Court has felt it is tackled. So to go to, there's many more interesting issues, that, at least in the minds, not in my mind. To me, if I were on the Supreme Court, I'd be granting certiorari left and right to tax cases. Forget about, you know, issues like abortion and those issues. Let's get to the real interesting issues, right? The tax issues. But no one's putting me on the Supreme Court. All right. So we looked at source of authority, and then we dealt with, I raised some policy issues about that when Congress is constructing the code, that in the back of every member, at least in my mind, if I'm a member of Congress, that we're going to consider equity issues, right? Horizontal and vertical equity issues. We're going to consider administrative ease. And we're going to try to design code sections that administratively people can understand and grasp. And we're going to try to come up with a tax code which raises sufficient revenue to meet our country's needs. So that's chapter 1 in a nutshell. Any questions? Chapter 1 is not my go-to chapter for tax questions, right? For exam questions, right? Again, your exam is open book, open note. It is not no electronic devices, and you can't bring your favorite friend who is tax knowledgeable, okay? So you can bring yourself, notes, and any written material. So if there's any supplementary books you want to bring or anything like that, that is your choice, okay? So you can understand that Chapter 1 is not my, fertile ground as a professor for me to ask questions, because I do not ask historical questions. Your clients will not pay you to ask you history questions. I think it's useful and interesting, but it's not going to be something that they're going to ask you, okay? Fair? Though many of you practice, I think I speak truth with a capital T on that one, that they're not going to retain you for your historical knowledge, although it makes you a more dimensional kind of person. All right, Chapter 2. Let's just talk about what we covered last class, and see what you got with that. Nick, is income broadly or narrowly defined?
Broadly.
And Karen, would you agree? And what's your authority for that? Say it loudly. Code Section 61, right? Code Section 61 says generally all accretions to wealth are taxable. Agreed? And Jesse, did you see anything in Chapter 2 that suggested otherwise? Or any accretions to wealth not taxable? No what? Are all accretions to wealth taxable? Always, James? What did Chapter 2 raise that's not taxable? Remember? Jackie?
Yes.
What?
Yes.
Gifts are in Chapter 3. So I'm just, did you hear anything in Chapter 2?
Anything like a wise business decision?
Bargain purchase.
Say again?
Bargain purchase.
Bargain purchase, okay. The authors raised that aside from a bargain purchase. Was there anything else the authors raised that would not be? And just help me with the names.
Taxation.
Nikisha.
Yes.
Okay, I'm going to have to work on that. Nikisha.
I think it was the frequent flyer miles for business use or personal.
All right, the IRS took a policy perspective with respect to frequent flyer miles, and it wasn't going to tax frequent flyer miles. But was there something else, like, Karen?
Did you tell me this was wrong?
Say again?
Did you assign me?
Well, I raised that Code Section 103, right? And we said life insurance proceeds are not taxable, Code Section 101. But those are specific code sections. What did, Stephanie, what did Congress say? Not Congress, I stand corrected. The authors, they gave us a Supreme Court case, okay, in Chapter 2 to suggest that something else was not taxable. What was that, Stephanie? Do you recall from your notes?
That one was income without receipt or of cash or bargain.
Well, what was that referring to? You guys remember? Larry?
Those are the wages with the Social Security wages that they shouldn't have to be taxed on the wages because they were students.
Look, that was Mayo Foundation, and that was for a different proposition to defer to Treasury regulations, right? Didn't we, correct me if I'm wrong, it's been 2 weeks, but didn't we get to Helvering v.
No,
Independent
we
Life
didn't.
Insurance
I
Company?
think we
We didn't get that far?
No, I think so we didn't.
Where did we get to, guys, on Chapter 2?
We talked about plane tickets and.
We talked about the fact that is treasurer trove generally taxable or not?
Yeah.
Generally taxable, right? We have the piano case right on point, the proposition that it's taxable. Then we had Old Colony Trust where someone pays your taxes, right? Taxable or not? And we said, gee, that's a pretty rich benefit, taxable, right? Old Colony Trust, agreed, taxable. And then we looked at Lynchrow Glass for the proposition that the receipt, right, punitive damages, all accretions to wealth, taxable, right? So the authors left us with all those things being taxable, Charlie B. Commissioner. Someone's able to monetize their frequent flyer miles. In that context, taxable. We talked about the fact that illegal income, is it taxable or not taxable? Anyone? You don't and that's just because you know from your friends, right, everyone? Right? For those who are drug dealers, prostitutes, and the like in the room, right? It's just a friend told you, all right? Again, for those coming in late, if you don't mind, I just need people to give me name placards, okay? So if you're coming in late, if you don't mind, again, your name placards, and if you didn't bring yours, remember to bring it, or else you'll have to see me come up to you and your name placard. Is that where we left off?
Yeah.
That's where we left off? Okay. So I usually pause for a minute or two, and we'll ask people, since it is a Monday night class, if anyone can remember their weekends, if there was anything exciting that you did this weekend to share with the class. I know that sounds like we're in kindergarten, but you know what? It's a nice little break for 2 minutes from tax once we summarize where we've been. So, Luca.
I went back to Pittsburgh. I went to the Pitt Penn State game.
Good game. How many people does that stadium say?
There were 7,000 people at the game.
All right, just a few.
That's like the most I ever had there.
All right, I will share my own experience. Maybe many of you have done this in this room. This is my first, so people can tell me if you've been there, done this. I did my first escape room. Has anyone ever done an escape room in this room? So you've done one. Where did you do yours, Diana?
Did one in Montclair and another one in New York City.
Montclair, New York City. I did mine in Morristown. And for the record, I did not escape. I would have been a dead man, okay?
Us either.
You didn't escape either. Anyone else do any escape rooms? You've done some escape rooms, David? You've done some escape rooms? All right, so for those who haven't done it, you get 1 hour with, we had a group of 10 people with a group, and you try with clues in this room or multiple rooms to escape. It's fun. It's good mental exercise. So anything else? That was mine. Any movies? Anyone see Sully or anything?
I saw both.
Sully, was it good?
Yeah, it was good.
Okay.
It's a shorter movie.
Say again?
Short movie, but good.
Short movie, okay. To hear?
Well, I ran a half marathon.
All right, look at you. All right, congrats. Congrats. Anyone ready to fold and I'll do to here? All right, there you go. Make sure as you're listening to your iPod that you're listening to tax as you're running. It will be very inspirational. All right. All right. Anything else to report? All right, then let's move on to where we left off. Okay. All right. Now, so is it fair for me to say that you guys, we finished up on page 63? Is that where your notes end? And we finished up, we did problem 6, and we're at the precipice of looking at Helvering, the independent life insurance company, right?
Yes.
I got overly ambitious and excited. I know we covered this, but that's okay. Let me make an observation that throughout the course you will look at many cases, and whose name will adorn many cases. It will be Helvering. And you might say, gee, this is a really litigious person, right? His name adorns so many cases. Why does it adorn so many cases? Because he was the former commissioner of Internal Revenue. So in yesteryear, it used to actually have the commissioner's name, in this case, Helvering. Today, we just say Commissioner B, whoever the taxpayer team is, okay? So just be on notice. If you cite to this case, don't say it's the Helvering case. That ain't gonna help much. So if you want to refer to the case, you will refer to the independent life insurance company, right? Because then we can all find ourselves. Now, insofar as this case is concerned, guys, it's an excerpt, right? This is not the entirety of the case. And it stands for a simple proposition found in the last line of the excerpt. Okay, so if you want to turn to page 64, it says the very last line, the rental value of the building used by the owner does not constitute income within the meaning of the 16th Amendment. The rental value of the building used by the owner does not constitute income within the meaning of the 16th Amendment. And this is a simple proposition. What is it saying? I'll translate. Many of you, right, do things, including myself, that we might otherwise have to pay someone else to do. And I don't know, some of you, like me, might mow your own lawn, okay? And normally if I have to hire someone for my lawn, it costs me $30, right, each time. And I have to tell you, after I'm done mowing my lawn, I really do feel richer, right? And we said from our first class, one indicia of taxability if you feel richer, right? Code section 61. Agreed? So I do feel $30 richer each time I mow my lawn, all right? I've earned it, right? I really have earned $30, right? I didn't have to hire someone else to do it. Having said that, do I have taxable income? And the answer is, that is what we might call, and use of language here is important, imputed income. Imputed income. Is imputed income taxable income? Is imputed income taxable income? And the answer is categorically no. Why? What's my authority for the proposition that imputed income is not taxable income? Independent life insurance company, right? Why is imputed income not taxable income?
I think it's because it would be difficult to assess the value.
It would be very difficult, right, Alicia, to assess the value from an administrative policy perspective. It would be extraordinarily challenging, and therefore Congress is not doing it, right? So imputed income is not taxable income. And we have authority for that proposition.
I'm sorry, what is it called for that?
There's no code section caveat. There is a Supreme Court case which is not bad authority, right? And that's the independent life insurance company, which is in your textbook. So you don't have a code section. You have a Supreme Court case, which again holds a lot of currency, last I checked. We have a revenue ruling, right, that follows on page 64. Revenue ruling 79-24. Nick, I don't know, did you have a chance to look at this?
Yes.
Can you just say in a few words what this revenue ruling stands for, what proposition? You don't have to go into detail.
Essentially, if you barter services, that counts as
Taxable to whom? Barter exchanges are taxable to whom?
both parties.
Yeah, I scratch your back, you scratch my back, guess what? We both have taxable backs, right? You paint my house, I'll do your mechanical work on your car. Each one is performing services on behalf of the other. That's taxable to both parties. Agreed? Agreed. This is a taste of what a revenue ruling looks like, right guys? For those who've never seen a revenue ruling. Revenue rulings are fact patterns that the IRS says, typically here's one situation, sometimes in this case, here's two situations. Here are the situations, here's the applicable law, here's the outcome. Right? Very simple revenue ruling, simple proposition. Just help me, I know I blew last time and then 2 weeks later, John.
Yes.
John.
Very good.
I'm going to make a mistake next time, so.
So, even if the profession of the person is not, like if it's not a profession, it will still be taxable.
Doesn't matter as long as you're reciprocating equal values or values.
I'm gonna go like extreme here. My friend, I help my friend paint and he pays me with beer. Is that taxable?
Beer is paid in kind. Regulation 61-2 would say that in-kind payment is cash to you, is taxable. Sorry. Hopefully it's not great beer so you don't have that much tax. I mean, here's a reality check. You know, let's face it, and you don't worry, I'm not wired. You're not going to pay tax on that, but you don't want to tell a client who's going to repeat this action that don't worry, it's tax-free. I mean, let's be practical. I mean, no one's going to say, oh, I'll report that under other income. But if it becomes routine where you say to your clients, you're a painter, oh, don't pay me in cash, pay me in kind, because that's not taxed. And my accountant told me that. That's not where you want to be. By the way, John, if you want to paint my house, I have some good beer.
Not anymore, it's not so.
That's it, have to give you more, we'll gross it up. All right, D&B Commissioner. Luke, you have a chance to look at this?
It's been a couple weeks.
It's been, you're a little rusty, Jeff? Yeah. Less rusty?
It's one with the funeral home. Rental.
This is not the funeral home. That's Happy, Commissioner. You don't remember this one? Not Diana? It's a one-page case. I don't need the details. Do you remember the case?
I don't remember how it ended, but I think it was something like, the Lyeth owned the property or the corporation, or the property, and then, but she also owned the corporation, and I think they changed the name, the ownership of the house to the corporation, something like that.
Why would they change the title to the house from their own names into the name of the corporation? What was the agenda here? Yolanda, do you remember? I'm sorry?
We have us trying to look into the case.
You're just trying to remind yourself? Edward, were you going to say something?
Yes, I understand that they have collateral bank loan and they need to put it into the corporation to back it on the loan that they have before.
Yeah, the bank says, look, we want security, right? We're going to lend money to your corporate entity. Corporations can quickly become shell corporations, so we want to have some real security here. So transfer title to your house to the corporation. Edward, was this the smartest move taxpayer could make?
Yes.
It was smart?
Somehow, yes, because you're gonna live free there.
Well, did they pay a price in this case?
Yeah, they apply because they have to put the house into the corporation, and if you go wrong with the corporation, they take the house.
I mean, what was the consequence of putting title to the house? Did they owe tax on the rental value?
Yes.
Yeah, because picture, if you will, if a third party, in this case a corporation, right, lets you stay, suppose you're working for an accounting firm said, gee, we'll give you a free townhouse that's worth $2,000 a month to live in. Do you have taxable income? Sure, you have $24,000, right? Code section 61. And by the way, let me say parenthetically, most of you are familiar with Code Section 121 that allows you to sell upon sale or disposition of a house at the first $250,000, and if you're married, $500,000 is exempt from tax, right? Code Section 121. Guess what? If your corporation owns the house, are you entitled to using Code Section 121? No. So on several different levels, this is just Edward, dumb tax planning, right? I mean, if the bank wanted a security interest, right, because they're going to lend money to the corporation, just have the people sign personally, right? So this was not a savvy move on the part of the tax planner. Nick?
Now, an LLC, you can transfer assets within the LLC and personally without tax ramifications, correct?
Right, that's Code Section 721, that if you form a partnership and you contribute property, it's a tax-free event. This is tax-free because you're contributing property to a corporation, and that this event is under Code Section 351, not 721. I'm not worried about the contribution being taxable, but you can see from an income tax perspective, it created income to these taxpayers, plus it forfeited their Code Section 121. So this was pretty poor planning, okay? So the authors stick it in here just for that simple proposition, once again, showing the breadth of Code Section 61. You guys ready to handle the questions on page 66? All right, so here's the authors asking a few questions. By the way, for those who couldn't make the first class, again, my methodology, rightfully or wrongfully, is to call people and just remind people, I do not keep a list. If your answer is less than perfect in your mind, I'm not losing sleep about it. And I don't have any rhyme or reason on how I call on people. So again, for the first class, or if you didn't make the first class, if you think I'm calling you too much, just send me a note to back off. If you don't think I'm calling on you enough, I've never gotten a note, but feel free to tell me you want me to ask you more questions. So just bear that in mind for those who are getting familiar with my methodology. So we have veggie grows vegetables in her garden. Does veggie have gross income when veggie harvests the crops?
No.
Emma? Is it Emma? Did I?
Anna.
Anna. Oh, it looks like two M's. So it's Anna?
Anna.
Okay.
No, when she just harvests, no.
What's your authority? That's a very, by the way, from our first class and forevermore, that's a very common mantra again on my part. What's your authority? It's not just good enough to have the right answer, right? Everyone agrees? You need to be able to match your intuition with authority. So what's your authority? And Matt, do you have authority for Anna?
We're not gonna, only as if it's an accretion to well,
So you're saying it's taxable or not?
it's not taxable.
But what's your authority? Because we just said,
Code
61 says things are taxable. Busto?
There's no authority because it's imputed income.
Is it- So what would you cite to?
Well, you can't bring it down.
The Supreme Court case, Independent Life Insurance Company, right, Anna? You don't cite to Code Section 61 because that stands for the proposition it is taxable. All right? Veggie and her family consume $100 worth of vegetables. Okay? David, would that make it seem more taxable or less taxable if they could actually consume it?
No, there is that.
Yeah, there's nothing, the difference between problem A and B, I don't see any material difference. That's not going to, and what would be my authority? Independent Life Insurance Company. Veggie sells her vegetables for $100. Brandon, taxable or not?
Taxable.
That, why?
61.
Yeah, Code Section 61. Veggie exchanges $100 worth of vegetables with Charlie for $100 worth of tuna. Tina, taxable or not? You say it loudly?
Yes.
Taxable, and you, what's your authority for that? When you say it's taxable, what would you cite to for authority? Serena?
The revenue law?
Which one is that? Which one is that, Nick? 79, 24, right? Hey, Serena? From the prior page, right? Tina, right? You, right? Okay, doctor needs to have his income tax return prepared. Lawyer would like a general physical. Doctor would normally charge $200. Lawyer would normally charge $200. What happens if they simply swap services? Jessica, taxable or not?
Taxable?
Taxable. Lewis, agreed? Disagree?
Agreed.
What's your authority, Lewis?
Would that be the revenue ruling?
It would be the revenue ruling, 79-24. Does the lawyer realize any income? A lawyer does his own tax return, Mike.
No.
What's your authority?
The imputed income.
So what's your authority?
Independent life insurance.
Independent Life Insurance Company. Right? All right. Chapter 2. David, you're the question.
Yeah. I paint your house. You give me some beer. I have income. I have income.
Who painted the house? You painted my
I
house.
painted your house.
And I give you beer. Yes,
Yes.
you have income.
You do not.
Why would I have income? I paid you.
All right. If you are a microbrewer and we do that same transaction, now I've almost bought some of your beer. Do you now have income? I've just bought it with painting instead of cash.
Yeah, and instead of using cash, I'm using an asset that they self-created, probably income to me as well.
So it's
I'm
the
selling
same-
my inventory.
It's the same transaction. Where's the break?
One is cash, which is, I'm using after-tax income, right? And beer, I presume I bought the beer
Okay.
using after-tax income. And the stuff I microbrewed, never brought to market. I drink my own beer, not taxable, imputed income. I sell it to you. I mean, it's equivalent of me taking my microbrewed beer, selling it, getting cash, and then paying you. Other questions? And that, is it that, right?
Yes, I'm not talking.
Okay, Netta, bring it on.
I'm a little confused with 1D when they exchange $100 worth of vegetables for tuna. How is that income if it's not service that they're exchanging, they're actually exchanging goods?
Yeah, but they've never been taxed on those goods, right? So Charlie went fishing, he's bringing tuna, like the beer that I brewed. And veggies bringing vegetables that have never been taxed. So each one's bringing things that to market that weren't there. It's equivalent of them selling it first and then giving $100.
Okay, so it's like selling, that's what they're getting.
Yeah.
Thank you.
Other questions? Ready to move on to chapter 3, guys? All right. The exclusion of gifts and inheritances. So the authors in chapter 2 talk about the breadth, right? The breadth of 61. And this course, no income tax course can cover all the exclusions from income, okay? We could spend the rest of the semester delving into detail, beginning with Code Section 101, dealing with the receipt of life insurance proceeds are not taxable. We could talk about Code Section 103, municipal bond interest. New Jersey floats bonds, your township floats bonds. The interest received on those bonds, not subject to tax, right? We talked before about Code Sections 104, 105, 106. One of the biggest ones, employer-provided health care insurance. Employer-provided health care insurance. The receipt of which is a very, very valuable benefit, right? I get family coverage at Rutgers, probably runs Rutgers $25,000. Do I have taxable income? No. Code Section 106. All right, so there's a lot of exclusions, notwithstanding the breadth of Code Section 61. And what the authors want to do is give you a taste with respect to gifts and bequests. Now, let me make an observation for everyone in this room. This course deals with the income tax. But there is, in our country, it's pretty weak these days, but there is transfer taxes. And what I mean by transfer taxes, chapters 11, 12, 13, and 14 of the code, beginning with Code Section 2001, has an estate tax. Beginning with Code Section 2501, the country has a gift tax. Beginning with Code Section 2601, the country has what's called a generation skipping transfer tax. Why am I calling these to your attention? I don't want anyone to leave here with the impression. Let's start with the general proposition. If you receive a gift or bequest, Ashley, taxable or not?
Not taxable.
What's your authority?
Section
102A, right? 102A stands for the proposition that that is not a taxable event, 102A. But at the cocktail party or the weekend event, you may hear people saying, oh, your tax professor has it all wrong. Because you're going to say, Ashley, right, not taxable. And then someone's going to say, but there is a gift tax, there is an estate tax. But they're referring to the person giving the gift, not the recipient. The recipient, 102A, right, Ashley? No tax. On your Form 1040, right, you don't report the receipt of gifts or bequests, agreed? But the giver, the donor, making a gift, may, depending on the circumstances, have to file a Form 709. You're not responsible for that. That is a gift tax that's a different course. Someone dies, and depending on the size of their estate, the executor may have to file what's called a Form 706, right? That's the estate tax return. That's not what this course is about. We are focusing, right, our energies on the income tax consequences associated with a gift of bequest. We're not looking at the effects to the donor or the decedent. Okay, everyone have that distinction clear? So the first thing that we look at is gift. What is a gift? And the authors try to sensitize us to what is a gift, the issue of what is a gift, and the Duberstein case. Which was written by Justice Brennan. Now, truth be told, there's actually two cases in here. There's the Duberstein case, and the Supreme Court periodically does this. It takes two similar cases and it wraps it in one wrapping and tries to resolve both cases. And here we have that. We have the Duberstein case and we have the Stanton case. Okay, so we have two for the price of one. Lucky us. All right. So, Louise, do you have a chance to read Duberstein? Not there? Okay, but I'm appreciative you're here tonight. Like I said, better to be here than not to be here. Let me just see if, Jesse, did you have a chance to read it?
Like happened today, I noticed that it's about like how Berman.
Oh, are you comfortable talking about Mr. Duberstein? Shaky? Again, for my purposes, I don't need detailed facts. I need the big facts, the big issues, and the top consequences. So, to hear, you want to cover Duberstein? What? Let me just make sure. Nikisha. I better spell that out phonetically. Nikisha, can you handle Stanton?
Stanton? Yeah, I think I can.
Okay. Now we got coverage. So to here, you want to take Duberstein. What happens with Mr. Duberstein?
Mr. Duberstein received a Cadillac as a gift.
Well, let's back up a little bit. How did he get it, and why did he get it?
He was in a business and personal relationship with Berman, and they had a relationship for a very long time. And then, as a gift, when they broke off the relationship, Duberstein received a Cadillac, and he didn't include it in his income, but Mr. Berman included it in his business expense.
So everyone, let's take a step back. Let's pause. Here we have a taxpayer who apparently, tell me if I'm wrong, refers work, a business to this other person, and as a result, gets a Cadillac in his driveway. Okay? So, as a result of giving him this, as a result of the taxpayer giving leads to this other taxpayer, he got a Cadillac. Agreed? And the question is that taxable, the receipt of that Cadillac, is that taxable income or not?
Yes.
And by the way, let me just pause and make an observation about my own life. You see if you share. I practice. I told you, I do a lot of tax and estate planning myself. And I send a lot of lawyers a lot of work because I can barely do tax and estate planning. I certainly don't handle divorces. I don't handle real estate sales and all that other stuff. Despite all the work I send to all these people, I've never had a new car put in my driveway, okay? The best I do is a fruit basket now and then, okay? So just pointing out that notwithstanding, Mr. Duberstein is pretty fortunate to have a new car put in his driveway. All right, so that's the Stanton case in a nutshell. And I can't get over how it probably, given your letters of your name, Nikisha, right? Nikisha. Stanton, what happens there?
Stanton was employed by a church. He was the comptroller. And he worked at the church for about 10 years. Supposedly everyone in the church loved him. And as a parting gift, they gave him
they gave him what?
$22,000 over a certain period of time.
Right.
That's the gist of it. Like, as we got more into the case, there was like a dispute. I was a little confused with that.
Well, Stanton stood up and tried to, how do I say it? Someone was being kicked out of the church, and he helped protect, or said that this person, my read of it, Nikisha, was this person wasn't what you portrayed him to be, and as a result, the board did not like what Mr. Stanton did and said, you know what, if we kick this one guy out, and since you're trying to protect him, we're going to kick you out too. So despite the love we're not so sure if there was such a love going on there, okay? And he gets 20, gets a cash payment, and maybe it was out of love, but maybe it was like, don't let the door hit your backside on the way out, right? Type of thing. So there are two fact patterns. We have two taxpayers, Mr. Duberstein, Mr. Stanton. We have to figure out what are the tax implications. And that comes down to one issue, right? Is this a gift? Because if it's not a gift, we know Code Section 61 applies. If it's a gift, Code Section 102A applies, right? So we have to, right to here, figure out, is this a gift? So what is the court? And by the way, let me make one other point, because in the code, many of us, I think, gravitate, well, outside the code, let me start with that, gravitate in life towards this notion of symmetry, right? Do most of us like symmetricalness? I don't know. I think that's kind of a human trait. You like symmetry, right? Agreed? In artwork and facial reactions, there's a lot. People say symmetry. In the code, will you necessarily find symmetry? Because Tahir said, right, Tahir, that one taxpayer deducted it, right, which suggests that it's not a gift. Does that necessarily mean it is income to the recipient?
No.
And that's the point I'm making, is that not necessarily. And let me extend that. That in a lot of places, the code is asymmetrical. A good example of this, for example, is with respect to your employer may make a 401k matching contribution. Get a deduction, right? Do you have income? No, completely asymmetrical, right? My point in raising this is do not be fooled and search and say everywhere you look in the code there must be symmetry, because there are asymmetrical outcomes, right? I just want to call that to your attention. Wes?
Let's say, I just want to go back to your example. Let's say your company gives you a 401k contribution. That's not taxable.
That's not taxable.
It's not an accretion of wealth, though.
That is an accretion to wealth, but there's special exceptions spelled out in Code Section 401 to say that is not included in gross income. So it serves as a shield to Code Section 61. So 61 is our starting point, but then there are, as we're seeing, 102A is one, 401 is another exception. Okay, so there's asymmetrical outcomes, right? All right, so with respect to Duberstein, the government proposes a simple test on page 71, at the very bottom of page 71, footnote 6. It says, gifts should be defined as transfers of property made for personal as distinguished for business reasons. Excuse me, the government would have a very simple test, right? Easy to apply. And in this context, since this transfer is made for business rather than personal reasons, the government would shoehorn in the outcome and it would result in 102 not applying and Code Section 61 applying. To here, does Justice Brennan buy into the government's simple test?
No.
No. I mean, personally, I might have, the Supreme Court Justice, I might have bought into it. Instead, right, here, beginning on page 72, Justice Brennan says on page 72, the first full paragraph, he's going to explore what is a gift, okay, on page 72, first full paragraph. And towards the middle end of page 72, first paragraph, it says, a gift in the statutory sense, on the other hand, proceeds from a quote-unquote detached and disinterested generosity out of affection, respect, admiration, charity, or the like impulses. It says, you keep reading, what controls is the intention with which payment, however voluntary, has been made. So Justice Brennan says, essentially, we must look at the intention of the donor. Is that easy or hard, guys, to ascertain? Yeah, I don't know my own intentions. How am I going to know someone else's intentions, right? And he's suggesting that this be done on a case-by-case basis. Does the IRS really have the resources to do this on a case-by-case basis? So I'm not a big fan of, I like Justice Brennan, but not, this becomes rather hard to put into practice, but it is what it is. Duberstein is still a respected court decision. Just think it's very hard from an administrative position, albeit most of us really know what is done out of disinterested generosity. To hear what does the Supreme Court say in Duberstein, taxable or not?
It is taxable.
It is. This did not meet this test of disinterested generosity, right? That it was done, right, as a quid pro quo for the business leads. That this was not just done out of, again, generosity. Keisha, what happens in Stanton?
I think in Stanton, it was not taxable.
Is that what it holds, Jay?
No, I think it is determined that it was taxable.
Was taxable. Stephanie, do you agree?
Yeah, I agree.
Brandon?
It was taxable, and they found it not taxable, then they saw there wasn't enough facts and they remanded.
Okay. So initially, Brandon, what did the lower court find?
Actually, I think they found it was not taxable.
The lower court just simply said, this is a gift not taxable. The district court, okay, made this declaratory statement, this was a gift not taxable. The appeals court reversed, and the Supreme Court, Justice Brennan, has to look and figure out whether or not this was done out of disinterested generosity. Justice Brennan says, look, right, Nikisha, the lower court is the fact finder. Everyone agree? The lower court is where you have witnesses come and where discovery is made. Did the lower court make much in the way of fact finding? Did it explain its rationale for why it decided this was a gift? No, it just simply said, this is a gift. It was like an edict from a king, right? It didn't explain the rationale, and the Supreme Court feels frustrated, saying, look, how can we opine whether or not the reasoning here was correct? It just was conclusory. So the Supreme Court remands it, right, Nikisha, to the lower court and says, here's the test that we're adopting. Now, given this test, now apply it and explain whether or not, draw your conclusion and explain how you arrived at that conclusion. Did everyone see that in the notes that followed the case, it was remanded? And Alicia, how does the court hold? When it's remanded back to the lower court?
Court of Appeals, Second Circuit, reversed the decision. This is what you're...
So what did the lower court, the district court, before it gets remanded?
They decided it was a gift. The trial court decided it was a gift.
Right.
And then it was reversed.
No.
No.
Look on page 78.
Hold on.
On page 78, it starts at the very top. The top, there's an incomplete paragraph that is a carry forward from the prior page. From page 77, and at the very end of that paragraph, it says, the case was therefore remanded. The district court on remand with more detailed findings of fact held that Stanton had received a gift, and the Court of Appeals affirmed, right? So who prevails? The taxpayer. Now, was I present? Absolutely, categorically not. Okay, that's a different issue. That was neat. But truth be told, I don't know, Nikisha, would you have knowing what you know, would you say Stanton received a gift, or did he receive some sort of severance payment? I'm going to put you on the spot. Don't fence it.
It sounds like severance pay.
So you would have taxed or not taxed?
I think I would have taxed it.
Yeah, me too. I don't know how the court came to this determination that it was a gift. I mean, this to me sounds to me more like hush money, right? Like, James, you're gonna say?
Yeah, but didn't it start off as a gift because he was so well liked?
I don't know if that was sugarcoating to get rid of him. Just say, look, you keep your secrets.
Well, you can sugarcoat it and, you know, usher someone out and make it look nice, but still, yeah.
Let's remember, self-serving labels don't control. So, I don't know. I wonder. I think what helps, Nikisha, were you going to say something?
I was gonna say especially how it was distributed.
What do you mean? Tell me more.
Well, they didn't give him, here's $20,000 gift, it was over.
I mean, keep your mouth shut, and if you don't, we'll take it. We'll stop making the payments. All right. I mean, there is an element that may be true of that. And the thing that I think saved him, obviously now I'm reading beyond the lines, because he's a member of the clergy and part of a church, there's a little bit more, I think, latitude that the court or a jury might find here, because it's sort of not your typical for-profit enterprise. If this was for-profit, I could be wrong. I think the case would have definitely come out differently, only because it's packaged. Karen, am I sounding too cynical?
It wasn't for-profit, it wasn't the church, it was the operating company for all the land around Lower Manhattan that Trinity Church owned. So I thought this one was absolutely taxable income. But the other one seemed so much more like a real gift. I mean, he kept saying, no, I don't need a car, I've got 2 cars already. He was already giving him all that information for years without getting a gift, so why just think like, oh, now I'm getting a car, it's going to make you keep giving it to you, he was already doing it. That to me seems so much more wrong than he got taxed.
I mean, still, the church was involved in this land thing, so I agree. It was one step. All right, look, we can agree to disagree. It's not a big deal. All right, you're just getting a taste. These kind of issues don't come up that often in anyone's office, but it gives you some flavoring. Page 78. There's 2 problems there. It says our system of self-assessment requires the taxpayer to make the initial determination of gift or income. The tax administration procedures give the commissioner the power to challenge that decision. The judicial controversy develops. Why is the decision of the trial court so important? What role does the appellate court apply or play? And let me just, again, I tried to make this point clear in the Duberstein case, is at the lower court levels, that's where all the facts are put on the table. Okay, that's when witnesses are brought in, that's when people submit documentation. All your dirty laundry or clean laundry is put out there at the lower court level. The job of the appeals court is simply to find, was the correct law applied at the trial court level? At the appeals court, no witnesses are called, no documentation is entered. It is strictly whether or not the correct legal analysis was applied. Periodically, if the fact finding is truly egregious, that there is a fundamental error about what they perceive the facts to be, then the appeals court will probably remand it and say more fact finding needs to be gathered. Okay, so that's why it's so important at the lower court level that accurate facts are put out there. Question 2. We have Head's Eye Casino, Vegas. Lucky Lewis gives them each a $50 tip to assure a good table. He gives the, you can tell how often I go gambling. I'm going to mispronounce it. Croupier. Is that right, guys? You gamblers out there? Aaron, did I do all right?
That was croupier.
Croupier? All right. A $50 token after a good night with the cubes does either have income. Is it Jenny? Did I say that right? How do I say your name? Yes. Joanna. Joanni. 3 syllables? Joanni. I have to work on it, Joanni. Taxable or not?
Taxable.
You say taxable. And to your left, I'm sorry, your name is written in very small letters. Yes.
Raphael.
Raphael, okay. Tax, would you agree with Johanny?
Yes.
What's your authority, Raphael?
I would say 102. Code 102.
For the proposition that it's taxable, you just said it's taxable. 102 says it's exempt. So you don't want to say to 102. Jesse, you have your hand up.
Section 61,
But section 61.
because tips are also for gross income.
Okay, so it's an accretion to wealth, right? And is this truly a gift? I mean, one hand, someone could argue it's a gift, right? You weren't forced to give anyone any money, right? Everyone agree? And the recipient could say, well, I received this out of disinterested generosity, but, Jesse, if you were gambling, why would you give that money?
For extra service.
Yeah, for good service, right? And hopefully that person's presence will increase your luck, right? There's some sort of quid pro quo, right? Ashley?
For me, it seemed like the first one was for service, because he's ensuring a good table. But the second one to me seemed like a gift, because he's just saying, I did well, here you go.
Yeah, but I don't know if you're a gambler, Ashley. You're expecting something, you're expecting a damn good hand in return for that money,
But
right?
no, they can't.
I mean, if you pay a fortune teller, you know, the same sort of philosophy, is it income to the fortune teller? Sure.
Yeah, if you're gambling, it's
You're hoping that person controls the future, right? I don't know if my metaphor or analogy works there, but definitely going to be income.
So both of them are income?
Yes, it should be income. Good section 61. Raphael, you don't want to say to 102 because that's the proposition. It is exempt. Joanne?
Yes.
Yes.
So let's say I went to the land city, I paid $500, I gave somebody the croupier
Right.
$50. Do I claim 450 or 500?
All right, go slowly. Say that back kind of more.
So I won $500.
You just won.
Of the blackjack.
Right.
And I gave the person beating 50 out of those 500. Do I claim 450?
You have to claim 500, okay? And everyone, when I say claim, you have to report 500 as taxable income. What's my authority? Code section 61, right? Now, let me take a step back. I've never had to do research on this. I know if you go to the horse races, let me tell you what I know and what I don't know, okay? If you go to the horse races and you gamble, you can deduct the cost of your ticket, okay? Or tickets, right? So in a year, if you win, let's keep the number simple, $1,000, and you spend $200 on horse racing tickets, at the end, you have to report $1,000, but you can show $200 worth of tickets that you bought. You can claim $800. And there's the old story. Does everyone know, quote unquote, the old story? You do not want to show the $200 worth of tickets that you have with footprints at the bottom of it, right? Because it just means you probably picked up other people's loser tickets, right? Right? So that's not what you want to do. So I know that you can take as an expense that you can take as a deduction the expenses you have for earning gambling income. I don't know when it comes to these other services, assuming you can prove that you actually gave chips. Remember, there's an evidence that you actually, you know, if you have the tickets, you have evidence to show that you spent money. It's going to be very hard to prove that you had $50, but let's just assume you could. You could get an affidavit. The question I would have, Code Section 262 disallows expenses for, like if you go to a good restaurant, you give a tip, not deductible, right? So I don't know if the service here is like they're going to give you drinks faster and other things faster, a good seating arrangement. So my inclination, John, is that it would be deductible, but I'd have to do more research on that issue. All right. Employee gifts. Okay, so generally, Code Section 102A says that the receipt of gifts, not taxable, and the receipt of bequests, not taxable. Suppose you work for a company and your employer gives you a gift, taxable or not? Okay? I heard someone say taxable. Who is that? The taxable. Akeisha, what's your authority?
Section 102C.
And Luca, would you agree?
Yes.
I think you would agree, but I don't think you would agree. And let me put words in your mouth. Luca, Nikisha, this is Luca speaking through me. Luca would say to you, Nikisha, 102C simply says 102A doesn't apply. It doesn't cause tax. 102C simply says 102A doesn't apply. That means in the absence of another exemption, Code Section 61 would make it taxable, right? Notice that 102C is not a taxing provision, right? 102C simply says 102A does not apply. So in the employment context, 102A will not apply, opening up vulnerability to Code Section 61. Ivlana, did I say that right? Lead, say it again. And break it down by syllable. Evelina. Say it again. Evelina.
Yeah.
Okay, I gotta work on that one too. Evelina, is that always true? Or are all employer gifts always taxable?
No.
And if not, when are they not?
In section 132
Say it loudly.
In section 132
Well, 132E, I think you're referring to de minimis range benefits, but that's not in the nature of a gift. That's a benefit they're conferring upon you in the employment context. Anything else come to mind? James, you were going to say?
If their employee did very well.
What do you mean by did very well? You ought to have authority, right?
Right.
James, does she have authority?
74.
Say again?
74.
Code Section 74 pertains to gifts, prizes and awards, which says they're taxable. So Code Section 74 won't help you here. What do the authors mention, Kadia?
Is section 132 fringe benefits?
No, but that's, Evelina just said that, and I just said, well, that's a different, that's not what the authors are referring you to. What happens if one of you work, go ahead, Ashley.
Employer gifts to non-employees. So it was like the 25, you give a gift of.
But that's outside the employment context, right?
Oh.
So if I refer work to someone and they give me a gift, that's out, I don't work for that person, right? So if they give me a gift out of.
It's only like, say I work, like one of my clients, like I'm a CPA, one of my clients for Christmas, I give them like a mug or something. They're not my employees, is that one 270?
274 refers to a limit on the amount that's deductible.
Okay.
It's not an inclusion section.
Okay.
So if you work, Ashley, suppose your mom is a CPA and you work for your mother. She's your employer. And at Christmas or pick your favorite holiday, she gives you a gift. Taxable to or not? Because
I think it depends if you can prove that the gift was not for.
and then I'm going to say, Ashley, what's your authority? Because there is authority. And by the way, those who are getting used to this textbook, again, the reading, look, there's reading, but the authors always give you code sections to read and typically regulations. And Ashley, on page 78, do you see the regulation, proposed regulation 1.102-1F? Do you see that?
Yeah.
What does that regulation say?
Does not apply to related parties?
Fasto, say again?
Does not apply to related parties?
It says that if you give to objects of your natural bounty, people like your children or grandchildren. In that context, that if the transfer was not made a recognition of your employment relationship, that it would not be taxable. So if your mom gave you a holiday present, right, Ashley?
Yeah.
You have authority, right? Evelina, that's the authority I was looking for, the regulation, 1.102-1F. For the proposition, so we have, guys, you're going to see this in the code. You're going to see a general rule, right? 102A, gifts are generally not subject to tax. You're going to see a possible exception, right? 102C, an exception. And, Evelina, you're going to see an exception to the exception with, in this case, the proposed regulation. So this is not unique, okay? This is somewhat commonplace. Particularly the code having a general rule and then several exceptions. But sometimes it has the rule, exceptions, and exceptions to the exception. And I just point out what Ashley was pointing out on page 80 is that the person making the gift, not the recipient, the person making the gift may be restricted in how much they can deduct. Okay, so the person making the gift under Code Section 274 may be restricted in what they can deduct. Not what it's not the effect on the recipient, it's the effect on the giver. All right? Page 80, the problems. Employer gives all of her employees except her son a case of wine at Christmas worth 120. She gives her son, who is also an employee, wine worth 700. Does the son have gross income? No. Does the son have gross income? Zach? Yes? No? Louise, see if you agree with that.
I would say yes for 120.
The son has income.
Yeah.
And Louise, do you agree? You don't agree. Why not? Say again? It's a gift? Let me just ask. Gia Yin? What do you say? You gotta say it loudly, whatever you say. Is that your loud voice? You say it's taxable. Why do you say it's taxable? What would be your authority? Yeah?
Thinking it's taxable for 120.
Why would you say it's taxable for 120?
That part of it is part of the employee relationship, whereas the rest of it's because he's the son.
Well, the regular, Nikisha, you're going to say?
I'm mumbling, but I'm agreeing.
Luca?
I would disagree with that because I just think that this gift is just totally different and it proves that it's for her son and not for her being an employee.
So you say it's exempt?
Yeah.
What's your authority?
102.
The regulation, Treasury Regulation 102-1F. Larry, you were going to say?
I think it's taxable because it says at the very end, it said substantially contributed it to the family relationship of the parties and not to the circumstance of their employees.
You say that it's more likely to make it taxable or not taxable?
I think it's taxable.
Wouldn't that be the converse? Wouldn't that make it more likely to be not taxable? Larry, if I said this son worked 5 times harder than every employee billed 30 hours, your son, superstar son that you have, Larry, bills 100 hours a week, okay? Get the visual? And because of that, it could be someone else But, meaning, if David billed 30 hours, Jay Sola billed 100 hours, I would get that nice case of wine because, Larry, you would want to reward me for that working 5 times harder, right? So if the person, in this case the son, worked much, much harder than the other employees, we would have much more likelihood of being taxable. Why? What code section? Annetta? 61, right? Because 102C would apply, knocking out 102A, back to code section 61. Sounds like shooting ladders, right? 102C knocks out 102A, we're back to code section 61. On the other hand, right, Larry, if the motivation is here, the son does same amount of work as the other employees, and mom just wants to be generous because it's a holiday and it's her son, gives him a gift, probably the treasurer regulation would apply. Can I say it definitively? I can't say it definitively, but that's my instincts based on how the problem is framed, David.
Wouldn't the safe default be that if it's happening at work, you should default to it is a work-related, not a gift, in absence of other evidence?
Yeah, but I mean,
Like,
it's her son. There is other evidence.
Yeah,
And then treasurer regulation was there for a reason.
This didn't happen at their house, there's nothing.
Oh, you mean physically the mom gave it at
It
work?
just seems like it was part of a work-related event. I'm giving out all of these work-related gifts, including this one. It wasn't.
I mean, again, we're not gonna have a definitive answer. I know some of you are gonna have a sleepless night in your notes. Oh, cow, well, I came to a tax class and here you want definitiveness. I mean, we can't give a definitive answer. And that's the exciting thing about taxes. I think the better argument is probably exempt, but I can't say that definitively. You were gonna say?
No, that's the question, because it seems like if she's giving gifts of different value to different people, she's differentiating between them.
She is differentiating,
She's
but
probably
one,
not their
the
services.
question is the differentiation based on the amount of work performed, which makes it more taxable, or is it differentiation based on the fact it's her son? Yeah, there's nothing in the regulations to say bifurcated and to say, well, treat part of it as taxable under 61, the other part because it's the natural bounty. It's all or nothing. No little pregnancy here. You're either pregnant or you're not pregnant. Question 2. Congregation for whom Reverend services administer gives her a check for $5,000 on a retirement. Does Reverend have grossing?
Yes.
Alicia, was that you? You say yes?
Yes.
What's your authority? And then Yolanda, see if you agree.
Code 61.
Code section 61, Yolanda.
Said that is not a school for the Western College.
I'm sorry? You say it's not. So you say it's exempt under what code section? No, just not. You mean code section. Tonight it's easy, guys. Wait until the end of the semester when you have lots of code sections swimming around in your head. Annetta? What code section?
I would say it's taxable.
Under what code section?
61.
So, Yolanda, you're saying it's not taxable under 102A, right? Where would you look for authority? Help you figure this out? And I know, Karen, you're thinking, nah, but certainly Stanton might apply here. People might associate it, you know, Reverend, the church, the whole thing. So if this weren't a church, again, my instincts are akin to the fact that I'd say it would be taxable. The fact that it's coming packaged, you know, in the context of the church makes it maybe citing to the Stanton decision, not taxable. I don't love the Stanton decision, but it is there. So again, I apologize for your notes. I think the better answer is probably taxable, but citing to Stanton, I could see an argument to say not taxable. Does not lend itself to a good multiple choice exam question, right?
Exactly, that was my question.
So Alicia, don't look for this on the midterm as a good multiple choice question. See, I'm helping you out here. Okay?
I have a question.
Yeah.
So it's not taxable under Stanton as opposed to 132E?
Well, this would never be considered de minimis fringe. Would you ever consider the receipt of $5,000 de minimis? In fact, cash can never be de minimis. Recently, when I say recently, 2-3 years ago, a company was giving out $50 gift certificates saying not taxable. IRS took a position that cash is cash, it ain't never de minimis. Right? De minimis has a mind if someone gives you the turkey, Thanksgiving turkey, that's de minimis. Right? Employee receives a $5,000 trip, an employee's 50th birthday to pay for the cost of the trip. Employer contributed $2,000 and fellow employees of the employee contributed $3,000. Does employee have gross income? Okay. I'm trying to practice names. So, Johnny, I'm not picking on you, but I'm trying. Did I do that all right? Johnny, taxable or not? And Raphael, again, I'm practicing names up there. Taxable or not? And you, see if you agree. So, Johnny?
Well, at first I had yes, but now I think it's no.
All right, so you're having this inner turmoil.
I didn't know there were 102.
So what do you say? No, nothing taxable, Johnny, under 102A? Okay, Raphael, do you agree?
I feel like it would be taxable because it's being gifted from, like, it's for its 50th birthday, it's $5,000.
So what's your authority, Raphael? It's not, no offense, it's not good enough just to have a feeling, right? You can have a romantic feeling, but that doesn't come in tax, right? So you have to marry that to a code section, right? You? Taxable or not you? You've got to say it beyond a whisper. I'm all the way down here. Say it loudly. What's your authority? Marina?
I think it's taxable under 102C.
Well, it's never going to be taxable under 102C. Right? 102C simply says 102A doesn't apply. Tina? Just say it loudly.
I think it's taxable for $2,000
$2,000 taxable under Code Section 61. Why? So the other $3,000 is not taxable? Again, you're whispering. The $3,000 is a gift. Nick, were you going to say something?
I tend to agree. Under section 61 by way of 102 C, I would think the 2,000 is taxable because it's from the employee or employer himself. The 3,000 is an actual gift collected by the other employees.
Right, it's not in the employment context. So 2,000 would be taxable. Why? Code Section 61, because 102C knocks out 102A. The other $3,000 is just a gift collected from fellow employees exempt from tax under 102A. Johnny, were you going to say something? I apologize. You got that? You can bifurcate the outcome. All right, everyone got that in their notes? There's no ambiguity about the answer. All right, we have this Lyeth v. Hoey case. Okay, and in this case, you have Mary, who has 5 children. 1, 2, 3, 4, 5. Unfortunately, one of her 5 children dies, survived by 2 grandchildren. This is a hard case to read, okay? This is not an easy case to read, so be forewarned. Let me just summarize it because many of you may have had trouble, but it is what it is. Let me make an observation or two and see your knowledge base here. Many of you, some of you in this room are married. So anyone married who I can ask this question to? Okay, Edward. Okay, and Alicia, see if you agree or disagree. Edward, sadly you died. can you leave, and I hope your wife's not listening to us, can you leave all your money to a girlfriend? You're worth $1 million. Can you leave it all to your girlfriend?
If I go to my will, yes.
You can. Alicia, you agree with that?
I think I agree. If you put it on a will, if not, then.
Let's say in your will, you can disinherit your spouse, is what you're saying, Alicia, right? I see a lot of nervous married people in the room. Karen, you're shaking your head?
Well, no, your 401k, that person has to sign off if you don't give it to your spouse, so.
What do you mean, they have to waive their rights?
Yeah, the spouse has to waive their rights if you don't leave them as their primary beneficiary, so.
Well, that's a retirement account.
But still, are you considered one person under the law when you're married, sort of, but, so, I don't know, I'm so mad.
John?
So I could do it as long as whatever money I have I wasn't married with my wife. So if I had a bank account with $1 million before I got married, I could give that $1 million to my girlfriend. But whatever money I make after that is my wife's as soon as I got it.
Really?
I don't know how to get over it now.
Louise, you want to say?
Policemen have the right to do that.
You don't or do?
I'm just a question. We have the right to.
Well, I'm asking you.
I don't know, because I know that on the French law, you can jury your wife for your birthday.
Yeah, but this is in Louisiana. We're not dictated by French law. Vive la France. Say again, Alicia?
It could also depend on the state you're in.
Well, let's say New Jersey. That's where most of us are residing. Can you leave it all to your, the pool boy or the girlfriend?
No.
No?
No.
And Alicia, what's the
I
rule?
don't know this section, sorry, but I know you can.
Right. So you married people, so most of you can sleep easier. There is something called an elective share, that in the absence of you waiving your rights, a surviving spouse has a right to 1/3 of your estate, okay? Because New Jersey doesn't want your spouse to become on the public rolls, right? Because that's not good from a policy. So Edward, I don't know if this is going to disappoint you or not. You do have to leave. If you leave it all to your girlfriend, your wife can elect against the will and take 1/3 of your estate, okay?
Is that specifically New Jersey, the 1/3?
Many states have different rules. New Jersey's kind of unique. New Jersey actually takes 1/3 where, like, let's suppose Edward left it all to his girlfriend, his $1 million, and his wife, just to keep the numbers simple here, suppose Edward was worth $900,000 at his death. Suppose his wife had $100,000 in her own name. New Jersey is one of the, most states allow the surviving spouse to get $300,000. New Jersey actually says you take the $300,000, the 1/3, less whatever's in the spouse's name. So she would be entitled to get $200,000 because she already has $100,000. So that's a little bit unique to New Jersey. Most states are 1/3. Okay, David?
Is 1/3 of the guy's 900, not 1/3 of the combined million? That's the starting number?
Yeah, it's the assets in his name. Okay? Now, let me by extension, why am I asking this? As a child, do you have any rights? So, Edward, if you had 3 children, you disinherit your children. Can your children, like your wife, make a claim against your estate? So picture, if you will, Edward's a widower. He dies and he leaves it all again to the girlfriend. Can your children make a claim? They can make a claim. Will they be successful?
Another story.
Will they? Do they have something akin, Alicia, to an elective share? And the answer is categorically no. You want to disinherit the SOBs? Go ahead. Right? I mean, in other words, the notion is in New Jersey and every other state, your children can probably, hopefully, economically survive on their own. They will not become a ward of the state. All right? So parents routinely, when I draft wills, not routinely, periodically will disinherit their children. And their children can get angry, upset, but my point is they have no right like a surviving spouse. Now, is it easy or hard to challenge a will? Very hard. It's not easy, okay? It's challenging to prove, like Edward.
So in another way, you're telling me that my child doesn't have the same right that my wife.
Absolutely.
So, that's not good. Because my child is my child. Wife, we any way I get to divorce it. That's it. My child will be forever. That's not a good idea.
Yeah, I'm just telling you, the law is the law. I just tell them like it is. Nick?
Is Warren Buffett doing something similar where he's not leaving his children large parts of his estate? He's actually.
Right, he's leaving it to charity. Yes, I agree.
Is the situation different if the child is under the age of 18?
It doesn't matter. They have no right to any part of your estate. Really? Really? Luca?
But if Warren Buffett did give the estate to his kids, wouldn't they take like half of it? Wouldn't the government take half of it anyway?
Boy, that's a different issue because that's the estate tax, right? They take, the estate tax rate is 40%, it's not half, right? And it depends on the state. And so, but that's an issue for a different day. My only observation, and why am I raising this, in Lyeth v. Hoey, the decedent here, these were her children, she was a widow, she left it largely to charity. And they're not happy, right? She was worth several millions of dollars, and they challenged the will, okay? The grandchildren challenged her will and say, notwithstanding that she left it to this church group that the earthly life of Mary Baker Eddy, that the founder of Christian Science, they're going to challenge it for testamentary lack of capacity and undue influence. Anyway, long story short, and this is where it gets hard to read, the case is settled, and the numbers don't mean much here, okay? Let's suppose, argumentatively, everyone here gets $40,000, okay? Doesn't matter. 40 added 400,000 doesn't matter. The question is, if you challenge a will and you're successful, and as part of the settlement you get X dollars, does that qualify under 102? A, as a bequest. The answer is yes, exempt from tax. Okay? So if you get a bequest directly in the will, not taxable. If you get someone dies without a will, that's called intestate. If you die with a will, it's called testate. If you die without a will, it's called intestate. If you get a bequest vis-a-vis intestacy laws, not taxable. If you sue and challenge a will, and you get money as a result of the settlement, not taxable. These are all means to the same end. And that's the Lyeth v. Hoey case. Not an easy case to read. Luca?
I'm sorry, was his wife going to be taxed when she received all his money or not?
I have a reaction. One, his wife, first of all, I say tongue-in-cheek, disinherited her. But let's suppose she gets 1/3. The receipt of that is not taxable 102A. And I'm just letting you know this, Luca, that under Code Section 2057, any money you bequeath to your spouse qualifies for the unlimited marital estate tax deduction. So if you're Warren Buffett and is he married or not? Yeah. If he leaves it all to his wife, there's no tax because any monies you give, if you're Bill Gates, you leave it all to Melinda Gates, you get that so-called estate tax marital deduction. So often there's no estate tax until the death of the surviving spouse. All right? All right. Waldor v. Commissioner, fun case to read. So let's talk about this and then we'll take a break. Fun case to read. Having said that, Mike, did you have a chance to read it? About a week ago, so you may not remember the details. Nick, did you have a chance?
Yes.
So what happened in Waldor?
The attorney provided the services to his client, and he wasn't paid at the time, but then he got money from her.
Okay, so lawyer performs services and says to the client, well, let's start with what he doesn't say. He doesn't say, gee, you're not looking too healthy today. He leaves that out. And he says, don't pay me. Instead of paying me for my services, I'll just put a provision in your will, leaving me X dollars, right? Everyone got the visual? And he obviously made a good, even though as a lawyer he probably makes a good position because after looking over his client, probably summed up the situation quickly or correctly. She dies, and leaves him X dollars, right? And the question is taxable or not, right? Because he did receive the money under the will, right, Nick?
Yes, but it was deemed taxable because it was just his compensation. That was
All right, so the court says, you could put a lipstick on a pig, it's still a pig, right? And similarly, by the same token, when we scratch the service, this was really payment for services rendered, and we're going to treat it like that, right? Taxable under Code Section 61. Now, is this lawyer probably should be, Nick, disbarred? Who drafts a will leaving themselves money? And I'm going to say, cautiously, my hand is raised, and I'll tell you why. I have a client who has a cat who can establish a trust for a cat, and she wants to leave her cat $250,000. Now, New Jersey, you can set up trusts for your pets, but the statute says it must be reasonable. All right? She is concerned because her cat has diabetes. You know how much my client spends annually? She has no children. So this is, in her mind, her child. How much does she spend annually on her cat?
50,000?
10,000 a year for dialysis and other treatment. Okay? So, listen, if you had no children and this was your world, I get it, I understand. And she's concerned, and I'm friends with her, she's concerned that that Brian will not have, the proper, medical care. So she said, let me leave $250,000 to you, and you'll take care of the cat, and upon the cat's demise, leave it to this, it's like the ASPCA. Okay, I trust you'll do it. I can fool anyone, right? Did I draft it? I drafted it, but I said to my client, there's no way you're signing this without having another attorney work with you, reviewing the will outside of my presence, and making sure this is truly your testamentary intent. I do not want to end up on the front page of the Star Ledger. So that was my precondition. I don't think Mr. Waldor did that, do you? So I mean, truth be told, I mean, I'm not looking for her money, so, and who's most likely to viciously attack that request? Charities are just really ambitious. And who protects the charity? The New Jersey Attorney General's office must be put on notice if a charitable request is made. So the first thing they would do is look at me. So I am trying to put in all the safeguards to doing this. My client doesn't have that many friends, and if I just said get lost, she would be really, I don't think I'm doing her a service. So I'm trying to dot my I's and cross my T's. But Mr. Waldor did not do that. He gets taxed on Code Section 61, okay? Page 89 has a whole series of problems. I'm having too much fun up here, so if we could take our break.